Good day, ladies and gentlemen. So in this particular video, I'm going to teach you how to use the balanced price range strategy. Okay, it's called balanced price range. Okay, BPR. So I'll teach you how to use the BPR strategy. It's a very simple strategy. Okay, so what is a balanced price range? The strategy is what I'm using to trade currently, and you can see how it's going. I'm using it to trade this volatility 75-1S index. Okay, so basically it has to do with a bullish and a bearish fair value gap overlapping. Okay, you already know that a bullish fair value gap is formed when you have three consecutive candles like this, whereby the wick of the first candle does not intersect. The wick of the first candle does not intersect with the wick of the third candle. So you have something like this. Okay, thereby leaving you with a gap in between. Okay, so this right here is your bullish fair value gap. This is your first candle, you have your second candle in the middle, and your third candle right here. Okay, so when the wick of the first candle does not intersect with the wick of the third candle and the candles are moving upwards like this, you have a bullish fair value gap. Okay, and for a bearish fair value gap, you're going to have three consecutive candles also. Okay, and you have a situation whereby the wick of the first candle also does not intersect with the wick of the third candle, thereby leaving you with a gap in between. Okay, which is your which is going to be your bearish fair value gap. Okay, so that gap is what we call a bearish fair value gap. So what is a BPR? What is a BPR? A BPR is simply an overlap of a bearish fair value gap with a bullish fair value gap. When you have that overlap, that level is a very, very strong level. So it's more or less like the fair value gap got inversed and the fresh fair value gap was created. That's just the idea. So with the introducing explanation, okay, with the introduction I've given you, you should be able to have an idea of what the BPR, the balanced price range, means. Okay, so I'm simply going to show you an example on the chart right now. As you can see, this is your first candle. This is your first candle, second candle, and third candle. You would notice that the wick of this first candle here does not intersect with the wick of the third candle. So I place an horizontal line on the wick of the first candle and also an horizontal line on the wick of the third candle to form a bearish fair value gap. Why is the bearish fair value gap? You can see that the candles are moving downwards like this. So this gap right here is a bearish fair value gap. Then we had bullish candles disrespecting the bearish fair value gap, okay, turning it into an IFVG, an inverse fair value gap. But in the course of doing so, a fresh fair value gap was also created here. Okay, you can see that if we take this to be the first candle of the fair value gap, this to be the second candle, and this the third candle, you will notice that the wick of this first candle does not intersect with the wick of this third candle. Let me place an horizontal line on the bullish fair value gap so you understand what I'm trying to say. Okay, so this is the bullish fair value gap. All right, so I have my bullish fair value gap right there. Now what did you notice? You would notice that the bearish fair value gap is as though it is inside the bullish fair value gap. The bullish fair value gap seems to be bigger, okay, while the bearish fair value gap is inside of it. So it's more or less like this bearish fair value gap is like a smaller version of this bigger one. Okay, so this one is the one we are going to use. This smaller one is the actual balanced price range. Okay, that's the one we are going to use. okay, and that's exactly what I used. You can see price returned there and gave us a bullish push. Okay, so price returned there into that smaller one and then pushed to the upside, though price is still around that region, but it gave me a good bullish push. All right, so basically that's just how to use the balanced price range strategy. Okay, you look for an overlapping bearish and bullish fair value gap, and then you take your trade from there. You can see price is still inside that range and price is still rejecting that level. Okay, I would have taken my profit, but I have my TP up here. If I had moved SL to BE, I would have been stopped out at break even. Okay, price has moved up to about 50% of my TP and then started retracing again, but the balance price range is still rejecting price. Okay, the BPR is still rejecting price. So basically, if you learned anything in this video, please subscribe to the channel and turn on the notification bell. I'll see you in the next video. Thanks for watching.